Well, hello everybody. I'm Ken Winans, and this is Stephanie Larson, and we wanted to give you our update, our weekly, as we were been calling it, the fireside chat as we go through the coronavirus situation. I hope that you and your family are weathering the storm well. I'm sure you're as stir crazy as the rest of us with staying at home. You'll notice that in the background, this is our library conference room. Many of you have not been to our office, but believe it or not, several of those old books back there do actually cover epidemics and pandemics, so how apropos. But I wanted to give you an update on some things since we're at the end of the month. A couple of things to keep in mind. We're in the middle of the second quarter. Although we're thrilled the way the stock market has rebounded, it's still very much an investment selection type of market, meaning a stock picker's market or a bond picker's market. Very clearly, there's still a lot of areas, whether it's tourism, whether it's even financials, that are not weathering the storm very well. And so the good news for us is that we've been pretty good about our stock picking. So even though we still have some cash on the sideline, we've been committing cash to companies that seem to be weathering the storm well. So I'm very happy about that. My market research right now, it is about a 50-50. It's kind of 50% positive, 50% negative, and it will probably be that way through a good part of the summer. I would also say that earnings-wise, we all know that the second quarter, which we're in right now, the earnings are not going to be pretty because last quarter, 2/3 of the quarter was on a pretty good note until everything really fell apart. So we're going to commit the rest of our money, at least on the stock side, once I see the companies that I have questions about, and which in your portfolios are companies where we have half positions in right now. If it's a full position, we're very committed to it. Half position, we're still not sure about it. We'll make our decision at that time as the earnings come out. But very happy with how the team's been acting and performing, and certainly in a moment Stephanie will talk about what's going on in the income portfolios. But I do think when you look at your monthly results, there will be a sense of relief that things have rebounded nicely. Remember, we don't do things on a month-to-month basis. We don't do things, certainly I don't want you doing things week to week, but clearly things are better. And a big part of it that we've been asked, Stephanie and I have been asked this question a lot, it's government stimulus. It's the massive amount of government money in to prop up the economy. And also, as so many of the companies reopen starting on June 4th, companies in our line of work, which by the way includes us, we will be reopening the office on June 4th. Limited hours because we have to adjust to our employee schedules, but we will be open. And as you can see, we're both dressed for business, and hopefully, we'll be able to see each other. So Stephanie, what did you want to talk about?
I was going to talk about the bonds really fast. We've talked about it over several of these videos now. We are trying to get the bonds fully invested, the portfolios, if you have an income exposure, to have that fully invested by the end of the quarter. What we've seen, and if you guys read the April newsletter, we talked about this briefly, was that in March, when everything went out with the market, when the market was going down, the bonds left the market too. And not just bad bonds, but good bonds also. And we found these really, really good bonds at really steep discounts. And it was this giant vacuum in that space that was created. And Ken and I had agreed after meeting together in the IC that we wanted to step into that space. We felt that these were good companies. They weren't going to go anywhere. They were short-term paper, high yields, deeply discounted, absolute no-brainers. And so we entered the market aggressively. Now what you're seeing over the last few weeks is the rally has kind of gotten some legs to it. The volumes picked up a little bit. Is that the bond market's starting to thin out. So that big giant vacuum that we saw is starting to kind of get a little lighter and a little tighter. We're still finding good bonds. We actually just bought two today that we liked very much. And so you will see them continually get put into your portfolio. We're hoping that by the Q2 reports that will come out in early July, that you guys will see what your income projections will look like for the rest of the year and be pretty happy with what we've done and what we've found. You also will see that in the bond prices and in the preferred prices that they've recovered quite a bit, like we said they were going to. They've come up with the market. Everything's kind of coming back to how it used to be. And that's also part of why the bond market's getting so tight now. The prices have recovered as things have stabilized, and yields have stabilized as well.
Absolutely. I'll add a couple other things too. As many of you remember from last year, we struggled where companies were constantly refinancing their debt. That is called bonds being called, basically refinanced early. We don't have that problem right now. Companies are putting out the debt, they're leaving it alone. I would also say too, a couple of things that are shifting the bond markets around. The people are, I'm hearing this from people. They're very concerned about municipal bonds. They're very concerned about whether it's local governments, state governments, county governments, or special or regional agencies will be able to match their obligations without bailouts from the government, from the federal government. So we're finding people are shifting out of munis and they're buying corporate bonds because these are companies that produce cash flow. You know exactly what they're doing. And I will also point out, many of you commented that, why are you buying oil bonds? Why are you buying bonds in some of these areas that are questionable? Remember, bonds are loans. We're buying shorter term bonds, companies that have weathered the storm well. I wouldn't own their stocks, but I have no trouble lending them money for 3 to 5 years out. So it all comes down to, is it worth having a place in the portfolio for a handful of bonds in an industry group that might be getting hit pretty good? It's a different thing.
Yeah, and know that we're not buying just oil bonds. That'd be insane.
Absolutely not.
I will tell you, as just an interesting point, actually, that most of the bonds we're seeing, a huge chunk of them are in hospitality and in oil and gas and energy. We're not touching the majority of them or even looking at them or considering them. It just happens to be there's a lot of issuance because there's a lot of need. There's been a lot of volatility in those markets. So they're trying to issue the debt to stay open and afloat. And we're just not interested in that. But there's a couple, one or two that we've found that we're very happy with.
Absolutely.
Yeah.
A couple other quick things on a macro basis. I've been asked by many of you, when would I begin to warm up to where this economy is going to go? A couple of quick things. Many people don't even think about it, but you need to take a look at what's going on in the commodity markets. There's massive dislocation. I'm talking about physical commodities, whether it's copper, oil, natural gas, food staples. There's massive dislocations where there's too much of a commodity in one part of the world that doesn't need it right now. And by the way, this is exactly what happened in the Great Depression. It took a long time for those commodities to equalize. Once that happens, I think you'll find that the economy, the underneath economy, will begin to, again, stabilize, and companies will be much more inclined to want to start investing again. Also, too, as far as furloughed employees, people coming back to work, we'll get a better sense over the next 60 days. How many people are going back to work as companies reopen? This is news in process, and we won't have the final answer until those pieces come together. One other quick point, many of you asked me about real estate. Last month, housing prices with our real estate index took a 4.7% hit. It was as bad as what we saw in 2008, but there's one caveat with that. Even the government statistical agencies admit that their sampling was off because they couldn't go around and collect data. They didn't have the employees. So we might find those numbers are not quite as bad. But just keep in mind, all of us right now are trying to gauge something where it's a little murky out there. You're not sure if the data you're seeing, whether it's pricing data on bonds, economic data from the government, is actually accurate. So we're being cautiously optimistic that this is beginning to stabilize, people are getting used to it, and we'll take it from there. I just want to say very quickly, look, it's been stressful on all of us. We appreciate your patience as clients. We appreciate your business. And I think that we'll all weather the storm well, and we'll move on from there. Stephanie, anything else you want to add?
The only other thing I wanted to touch on in the fixed income space, I had gotten some questions, and we were discussing our bond ladders this morning, actually. Why we're buying such shorter term paper. It's kind of skewing our ladder so that we're bunching towards the shorter end. There's actually a couple of reasons. One is that we want to make sure that we're being cautious with what we buy for how long we want to be indebted to these or buy the debt of these companies. But secondly, we're finding that when the yield curve inverted, normal yield curve is like this, kind of flattens out, or if it inverts, that means that the longer term yields are actually worse than the shorter term. And so when that happened, there was no reason to buy a bond for 10 years if you could buy the same bond for a better yield for 3 years. So we're also seeing that just happens to be the better issuances that we found. So you'll see some bunching in your portfolio in the 2, 3, 5 year range. And we're really not trying to go too much past that, but we will if we find something that we really want.
Absolutely.
Yeah.
So please, if there's any other questions that come up, please feel free to call the office. And I know Amy was on the last video. I know she would want me to pass on to all of you. Dealing with the brokerage houses is still problematic. I mean, I know a lot of you get very frustrated with the slowness of paperwork, getting things done, opening accounts, and we apologize for it. It's completely out of our control.
Yeah.
So just please bear with us. We're doing the best we can with wires and moving money around and getting money into grandkids' accounts and all the things that many of you are used to doing. We're doing the best we can, but when the brokerage houses still have half their people working at home, it's painful. So just please don't beat up the messenger. We're doing the best we can, okay?
Well, I also wanted to say, I know that I had sent the prime brokerage addendums out to everybody. Not everyone even understood what they were, and I'm glad that people had asked if they didn't understand. It just allows us to do block trading in bond markets. I know that all of you guys, I think 99% of you guys got those back to me really fast. I sincerely appreciate it. It really makes my life a lot easier and the broker-dealers' lives a lot easier. So I thank you very much for doing that.
And one final comment I'll make. Many of you have asked about contributing more money into your accounts for investment. You'll notice that we have spent a lot of, or we invested a lot of money over the last 20 days or so. We still see opportunities out there. As I mentioned before, it's not necessarily to try to promote you giving us more money. There are still opportunities. And remember, I'm always very seasonal with the markets. As we get ready to go into the late summer, going into the early fall, I like to step into things more assertively during those time frames. Markets typically really stabilize in the fall and move well into the winter time. So just kind of keep that in mind. But again, thank you for your business. Feel free to call us with any questions, and we wish you well. Thank you.
Thanks, guys.